I'm sharing the screen with Brad Jelnick's podcast. I sent in the link last week at Tuesdays, but I'm not sure if it went through. Maybe it did. There's a lot of different channels or way you could listen to podcasts. They all channel back to the same ones that he pops in, and I'm underscoring this. I did it late last week, in the trading room, but I want to underscore this because even if you see that these are okay or you don't know if they help you, most of the people are going to say these are great, but I'm not going to twist your arm and make you say that they're great. But I'm just, if anybody in here, and nobody does, but if anybody in here worked for me, they would have to listen to these. They'd have to be able to listen to them as he popped in a new one, I think, today. I think he's going to create a subscribe where it's free still, but you subscribe to it, and every time he posts a new one, you get an email. I told him that's going to be the easiest way for people to follow him instead of keep checking back or remembering to check back. But he put in a new one today. Today's yesterday, June 11th. How to preserve your momentum. The only plan that works. Is this business going to kill me? But you could see they're 2-minute, 6-minute, 3-minute podcasts. This is really great stuff. And even if you think it's just okay, it's worth listening to. This guy is I mean, you guys all know and trust me, this is a real deal guy. So you could trust that when I tell you that he's an ultra successful trader, you know that he is. Look at this one, being right but losing money. Where have you heard that before? The going over some FOMC meeting stuff from the last one could be relevant for this one that comes in tomorrow. And all this stuff is really good. Is all of it's good. I've probably listened to half of them. So make sure you guys are listening to it or listen to it. If you're not, just know that it's one of those things that if you worked for Anthony and you didn't, you'd be fired. Take that the way you want. I'll copy this and post it to anybody else want this link. Let's do it that way instead of posting it to everyone. Oh, the heck with it. I'll just post it to everybody. Bruce, you haven't looked at it yet? It's probably the third time you heard about it. Well, you got this link. It'll bring you to this page. Really good stuff. And I'm driving people to it not only because it's good, it's going to help you, and that's what you guys come here for, right? That's why you go to the trading room, the team room, these weekly sessions is for me to help you. This is going to help you. And why I'm trying to drive more people to his podcast, because I know the more people that are listening, the more he'll do. The more people listen, the more he will do. And we want more from him. Trust me. So let's pull that aside and go to today's charts. What I wanted to do today was to talk a little bit about that with Brad and then really give you guys an update. Let's show the webcam. You guys want to do a webcam? Where the hell's my webcam at? Although my hair is long. I got to get a haircut. All right. I'm doing the webcam. So it's easier for you guys watching live to listen. Updates. That's what's important this week. The FOMC starts today and it commences today and it ends on tomorrow at 1 Central. You have to make sure you're prepared for that. Could create some volatility. ECB 7:30 is their press conference on Thursday. You have to be in front of your desk ready for that and prepared, because they will whip those markets around. The other thing is I want to make sure we're prepared for is a pending trade war that could surface, create some bearishness in the markets if the rhetoric turns into threats and the threats turn into actual tariffs. I think there's a June 15th deadline date for China. There's a deadline date for China on the 15th, and I don't know about with Canada. I think it might be the end of the month. But right now, you could see the markets and the equities aren't really scared. They're not going down after G7. But when we talk about the fundamental drivers with those yellow circles that I draw in the trading room, that's one that could get bigger and smaller as the rhetoric surfaces. Right now, it just seems like it could be a little bit of the North Korean summit hangover and a relief rally that it did pretty much go as planned. Not really a super bullish, but certainly not a super bearish result. And then they're kind of just taking a breath ahead of the central bank activity we're going to get tomorrow and Thursday. And so we talked about knowing what the drivers are. And if you don't, you're going to be caught by surprise. I think that there is no, I don't think there is right now a headline I could predict or anticipate that's going to come out that you could just buy or sell the market. I don't know what's out there. It's generally under the surface. It's the next Trump tweet could always drive us up or down. Um, but I think I don't know what it would be yet, but it could be some of the trade war commentary heating up from the EU, from Canada, from China. China's the worst. Right now, the market doesn't seem that it's scared about a pending trade war. And you can see that on a daily chart because we're drifting higher in equities. So just keep that in mind. Make sure you're prepared for this week for the stuff coming out. Now I'll stop the webcam share. Sorry for all the females in here. But we need to get you to pay attention. This has been, I'm just going to talk about today as a way for some psychological help for others. Not every day you're going to feel like you got a good read. And some days you feel like you got a good read and you don't, and other days you don't feel good and you actually are trading well. For me, when I don't have a good feel, I don't have a good feel, and I don't trade, or I sit back and I'm really patient because it's just confusing to me. That's me, and I think you need to understand that, it's okay to sit back, and say, okay, now the balance was truly identified in here. It's not as good of a pen and go to webinar. In fact, I'm going to get ready to go to webinar, and I want you guys that come in here, look for an email this week. Look for the email first before you do anything. That I'll give you a new invitation for the rest of the year for Zoom. So we'll do these meetings on the Zoom technology, not go to webinar anymore. And there'll be some stragglers who missed the invitation and things like that. That's why I've delayed doing it, but much better technology. It took me 20 minutes to get in this damn room today. This balance was the 8:30 from roughly the 8:30 open and to 10:30. And we talked about the move didn't happen until after the European close, which is 10:30 Central yesterday, and the same thing happened today. As soon as it navigated through the middle, which was around 88.5, the upside, I left the room, didn't want people short through 91 or long through 86. And the reason was because this balance was showing up and it was chopped. Now, I didn't have a good feel for anything before any of that, but when you get this market to, let me go to a 4 p.m. When you start to think, well, I'm not going to be short through 91, 92, even if I miss the top of the range, who cares? I don't want to be stuck short for this big move that could happen. Relatively speaking, that's a big move from 90 to 94 when the first hour today was just 5 points. But you look at this and you say, if I don't want to, I'm going to be willing to miss the top of the range because it's going to break out sooner or later. Now, if you just look to qualify moments to get long using either a red that can't get it to go down or a green that gets it to go up. Say it again, a red that can't get it to go down and a green that gets it to go up. Now, for the point of this meeting, you got to know, you remember the previous meeting we did a couple months ago about knowing where you're at on the map, knowing where price is on the map? So if you're trading around 90, 91, you know you're at the top of the map. You're in Maine. If you're at 86 after the first hour or so, you're in Florida. So you want to make sure that you know that so you can gain a little perspective. You also want to know this, and this is important. You want to know that the market has some imbalances not some imbalances, but that the market just moved. Let me erase these things here. The market just moves from here, watch this yellow dot, and then a red imbalance comes in. That's different than if a red imbalance came in here. Because if it comes inside that square, it would have just came from here. All right? Know where these edge zones of red and green come in relative to the move it just made. Know where these zones come in relative to the move it just made. So if you see a green coming in, know that, yeah, you could get short because maybe this is going to be a rotation that I thought could happen and go lower, but you better know that this is a green that's coming in near the bottom of this move. And the move is identified from this X here to this X down in here. That's a move. All right? Not a trend or anything else. It's a move. And now the green comes in, which means if you're going to get short because you think that the green at 87 quarter isn't holding, you better know that it's a pretty shallow pullback to go lower. Secondly, you better know that the 87 quarters never went offered pretty much in this sequence. Once they went bid, well, they did go offer, but they went back and forth a little bit and they never traded and went the next tick lower, which would have been 87. So it was a much better qualifier to get long than the green to work than the green not to work. Again, the whole concept of these edge zones in real time is green buyers come in, so the market should go up. If you're qualifying along, use it. Now you know the price where you might be wrong or nervous. If the market already moved up and green aggressive buyers are coming in, you might think they're late. And now the market won't go up like it should because these aggressive buyers are coming in and it qualifies as short. You follow? So know where you're at on the map when these green and reds edge zones come in to gain a little perspective as to what to do. Because there's two ways to use a green edge zone, for example. You could use it when it goes green to qualify long. You could use it when it goes green because it's not moving up and it's slightly below it to qualify as short. So far, so good. This is kind of a recap of what we did 3 weeks ago, but it's very important. It's helped a lot of people, and I want to make sure I circle back to it to let you guys know that it's helped a lot of people. You don't necessarily know that if it hasn't helped you or if you're not aware of it, but you do now. And I know because I'm talking to more people through the room than you guys obviously might. I do think that it's easy to say now that all I needed to do was wait for some green edge zones to play a breakout of the balance I just showed you between 91 and 86 in the first 2 hours, right? Just play the green imbalance. It's easy to say, but if you're consistent, it is in real time something you could do. It's less, I guess, it's less hindsight's 2020 is the point I'm trying to make, because now you could see it. I think that anybody in this room, remember, anyone in this meeting is because you guys are Edge members. That's the only way you're in this meeting. And I don't think inside this yellow square I just drew here, I guarantee you that everybody was either short and very nervous or cautious or weren't even looking to get short. Whether or not you caught the breakout, I can almost guarantee everybody in here, when this yellow square, when it was trading in here, was not looking to get short. And if they were creating very small risk. Is that fair to say? Based on what you know through this edge program and you know through this balance stuff and the congestion boxes and fights where I left you at the trading room, right? That's fair to say, correct? I doubt people were trying to get short in here. And again, if you were, you knew that you wouldn't want to stay long because this blowout was possible. Now, with that being said, you need to look for a red that can't take us lower, or look for a green to help take us higher and blow us up through here. Is it easy to do? Not necessarily, but it's a hell of a lot easier than just playing price. Now you're playing order flow along with price to break out. Just to recap, know where the red or green shows up relative to where you are on the map. It's really, really important. Let's go to real time. Here, this is a perfect example. Where are we on the map? We're in Florida. And you could say, well, why are we in Florida, Anthony? We just rallied from 86. Yeah, but right now on this chart, we're in Florida. That's Maine. This is Florida. The move is lower. The last move. Again, this is a short time frame chart. So the last move isn't up. The last move was from here so far to here. That's a move. And don't ask me, well, how many points constitutes a move, because that's not a good question. This is a move. Get used to it. Understand that the market essentially just went from the highs that it made 94 to where we're at now, 90, half 91 even. Where we at on the map is we're at the bottom of it, relatively speaking. And a red comes in. Where does he come in at? 91 quarter. This is a good place to qualify this green and start your clock that we could start drifting up to go back and test the highs. And if you're wrong, you know where you're wrong and when you're wrong. Because the market should start moving up because the red comes in after it sells off 4 points. Make sense? Now, with that being said, the market hasn't moved up for you yet. It's still trading 91 quarter. This is a green edge zone. It went to 90 half. It's also the open. Should it hold it and qualify? See, the red went away, but yet you're still using it, saying aggressive sellers have come in and haven't got to go lower. They could puke and go up, and you're going to give it time to work. If it doesn't, you could say that you managed your risk. Maybe you were able to take a small loser / scratch, or say it's the middle of the day. I knew that I had to be very patient for it to work, and it's just nothing's going on right now. You could see volume accumulating more or less because nothing is going on. It already made its move, and yeah, it could stop. Old resistance, new support, and a qualifier with the red imbalance, not quite being able to take us lower. I think if you really want to get better at timing it, what you need to work on now is ready, aim. You're not in yet. You wait for an ancillary to fire and buy the 91 quarters. Now think about that, right? Because even if you bought the 91 quarters, you could still pretty much scratch them right now if you're using this as a qualifier. If you're using this green edge zone, all right, ready, and the aim and fire became the red edge zone, and the fact that they couldn't go and stay 91 even offer, because that's where the zone came in. Came in around 91 even. Now it's gone away. Even the imbalance went away. And that could be the moment that you get out. Just be consistent. Or you're not even in. You're not going to fire until you see a jump in the NASDAQ, a jump in the Russell, a jump in the Dow, a jump in the DAX, or a move lower in the Boone or the bonds. There's a lot of ancillaries out there. I want guys to do another thing. And I think next week I'm going to talk about some journaling stuff that I created. I'm pretty sure it's going to be next week. You guys are going to like it. But before I talk about that, I want you guys to look at this. Hold on a second. Is it a positive or a negative correlation, Bruce? Looks like positive to me. All right, let me show you. Soy meal. Why would we care about soy meal? We don't, and we might not even. I'm just bringing up how something that you never thought could help you, and that is a relationship between a market that is irrelevant. And I don't see, I guess it's a negative correlation. That soy meal, though, is so, it's not necessarily thin, but it just doesn't move a lot. Doesn't have a big range. Because I watched it as soon as he brought it up. Now, he just is looking around. It's not going to necessarily be something that helps. I'm bringing this up because it's the things you're like, I never thought soybean meal could help make money in the S&Ps. And it really can't, but we're looking at it. What he found in his correlation table that there was a negative 90% inverted relationship between soybean meal and the S&Ps. So when soybean meal goes down, S&Ps go up. Is there a lead lag? Now for the past 30 days. Only the past 30 days. Is there a lead lag? I don't think so. But the point I'm trying to make is when you're looking for the right stuff like correlations, you'll stumble upon something that could help you immensely as a leader. I doubt this soybean meal is going to help you. The point I'm trying to make is sometimes it's the Bund like it was 2 weeks ago, right? And sometimes it's something that's not obvious. Could be the Russell. Something to give you perspective. I do see the soybean meal. Oh man, it's tough. Like today, they both went up together in here. You actually had the S&Ps push up soybean meal. Now, what could be the reason? Let's just say that this for the last 30 days was a good inverted relationship. Minus 90 is pretty good. And it probably highlighted, Bruce, right? On that spreadsheet. That's why I caught your attention. Anything above 90, above or below 90. Think of why they could be related, even either the same or opposite. I would think could have something to do with the trade talks, exactly. Where when stocks go down, hmm, that would be they're worried of a trade war so that grains would be more expensive. Is that the spreadsheet? I want to share the spreadsheet. Is this the one that I shared with people? I think it's the same one. It's the one I'll look at from time to time, and I shared with you guys. Bruce is now going to share it back with everybody else. This is what he's looking at. And I'm going to pull it in. MRC Online. You could pull it up if you want. But what's interesting about this is that you could take the, let's change the pen color. You could just follow the screen share. Along the top, this is the Dow right here. Look at the top left. Follow it down. It's obviously 98% correlated with the S&Ps and 86 to the NASDAQ. That makes sense. They're all stock indexes. You go down further and say, how's the Dow correlated to the DAX? Oh, no. Where's the DAX? I can't find it. Is the DAX not on here? Should be. Oh, wait. You got to go to in here. That's right. 30-day US and European correlations. You just got to go to a different link. So let's skip that for a second. Soybean meal would have been down in here. Minus 91 correlation with indexes. Makes sense. You got a minus 100 because it's the euro versus the dollar. Obviously, that makes sense. Some other big ones, the British pound to the euro. That makes sense that they would correlate almost 100%. You look at these guys down in here. These are some ancillaries in the energy sector. You got heating oil, correlates 96% of the time to that guy. I don't know what is that ITC. 97 RBOB, that makes sense. Heating oil to crude oil is not as big of a correlation as you might have suspected. Maybe it's a seasonal thing, and I'm sure it is. Let's erase these drawings and talk quickly about crude oil. Where is it? Now it comes and goes. Like it's not been a good opposite from time to time. It has, but you look at the correlation inside that box I just drew. That's the yen, and it's just 50-50 right now. It's minus just 28. Not a good inverted relationship unless it's a giant move. You don't see treasuries in here because you got to click over to, let's go to 30-day US and European correlations. This is a really good tool. Here's the, it's not the DAX. What's the DAX? DF, they have it. Symbols might be exactly what you look at with your platform, so don't get yourself all nervous. DF, here it is. Only a 32, 23 correlation to the US over the last 30 days, so it's broken down. That's when you really got to wait for a big spike or break in it because they've decoupled a little bit. And what's cool, if you hover over it, it tells you the product that this is Brent crude oil, which is going to be heavily correlated with, and I thought it would be much more correlated with crude oil. It doesn't make sense to me. Is that Brent? But I'm looking at treasuries. Here's a treasury, just 16 minus 3. Not a great correlation. Opposite right now between stocks and bonds. The Bund is OB. Again, not a good opposite correlation. It was that week when Italian bonds were dominating fundamentals, right? You don't hear me talk a lot about the Bund because it's not a helper. When it's a helper, now you really got to sit back and say, you got to get a big move up or down in these ancillaries for them to help. Tick for tick isn't going to help unless it's a high number in here, most likely. Okay, tick for tick. You can see the nice correlations that you have in the indexes, US. If you're a currency trader, obviously the pound is a good correlation with the euro, both versus the dollar. That makes sense, right? And then what do we have here? Gilt treasuries, they're obviously going to be correlated pretty tightly with US treasuries. Sterling, short sterling is quite opposite currency, the euro currency. And the British pound So good stuff. Sure, it might not help, but those are the things that do help when they work. Took a little time, and it's been kind of a nothing qualifier. We go back to this real time example, 91 even. To get you in, you don't get hurt if you're long. You haven't made any money on it either. But typical for time of day. I don't think it would have pushed you out. I don't think it would have pushed you out. It did go 90 half offer. Maybe it did. I don't know if you would have been in. And if you used an ancillary, I don't know if you would have clicked to get in. I didn't see and watch anything else move quickly up or down. One thing I'll add before I end this session is you're going to catch a spike or a quick move in another market when you're dome next to dome next to dome. But that website is a good correlation matrix. I first got exposed to correlation matrix back, it was on Bloomberg. One of the two economists that were analysts, not really economists, they were analyst traders in our prop group, pulled it off of Bloomberg. It's the first time I seen it, showed correlations, and they were really good opposite stocks and bonds because it was a really asset allocation driven environment back in the early 2000s. And we come in and out of that now. And we, but again, part of this session is to drive people and make sure you're listening to Brad's podcasts as much as possible. They're short, they're good. Review them, take notes, go back through them. Keep updated on the page because he puts a new one up every couple days. The more people he sees, he knows when people are listening to it. So the more people that listen, more listens he gets, the more inclined he's going to be to do more. That's just human nature. And trust me when I tell you, you're going to want him to do more and more and more. He's a real collaborative guy, and he has no motive. He really doesn't. He's not planning on charging for it or anything else like that. So he's a real firm believer in teaching is like learning. By teaching, you learn. The other thing is know where you're at on the map when you see these red and green edge zones light up or any qualifier. Know that, okay, I'm going to sell it, but we just broke 3 points. So just scratch your head as far as using a qualifier that way. And then a really good ready, aim, fire to keep you out of trades that aren't going to go anywhere is you got support, you got a red imbalance, can't get it to go down, and ancillary spikes, you click the offer to get in. We started about 20 minutes late. I had a technical issue. So again, I apologize for that. But I think this was a good session. Follow those links I put into the chat box, both how to listen to Brad and how to get access to that spreadsheet. Play around with them, look at them from that spreadsheet from time to time. Don't kid yourself. If soybean meal was working as an ancillary, as a great ancillary, we'd be watching and trading it. Who cares why at times? We'll see you guys tomorrow in the room or next week in this room. I'll post this within the next day. And then don't be surprised if you get an email to resubscribe to these Tuesday sessions for the rest of the year through Zoom. I want to port everybody over from here to Zoom because this technology is it's just not as good as it used to be.